Hello, everybody. Kirk Spano, April 2nd, 2025, Liberation Day. And I think I'm going to liberate myself down this elevator shaft. I'm just teasing. I think that we've been prepared for this, so I am not too terribly concerned, but I thought it was funny to put an elevator shaft behind me. We will see how things go in the not too distant future. But right now, we are opening at this moment, potentially limit down tomorrow. So last week I did a poll on X, formerly known as Twitter, and by the way, I changed my image just because I don't want to get black fanned or picked on the road. But I am now the Mandalorian online, and this is the way. So I am convinced that we'll have a limit down day this year. And in this poll, I asked people, did they think the limit down day would come in April, May, or June 2025 or 2026? I paid to have this poll put up on Twitter. 18,000 people saw it. Only 96 answered it. So I don't know if that means that there was 18,000 people who did not think that we'd get a limit down day, or if they're just too lazy to click. They didn't care. They're like, get this out of my face. But 35% of the very small sample size said limit down in April, and right now it could happen tomorrow morning.
5%.
Well, we'll see what happens. We'll see what happens.
The NASDAQ, what's it at 7?
Is it at 7 now?
I think the first trigger is at 7, so we're at 5.13 now.
Yeah. So we'll see what happens in the morning. Maybe this all dissipates. The Asian markets opened way down on the Trump tariffs. If you didn't see what the tariffs were, go to your handy dandy Bloomberg and they will explain it all to you. The short answer is this. They're doing a flat 10% on everything, but they put up a chart and they showed all kinds of stuff that was wrong, but they justified doing tariffs on certain countries that were just gigantic. 34% on China on top of what they're already doing, 20% on the EU, and they just went down the list. And they tried to say, President Trump tried to say that these tariffs are about half what everybody does to us. Well, it's just garbage because the EU tariffs are middle single digits, low to middle single digits across the board. There's a couple of outliers, but on average, about 3 or 4%. It appears, and they didn't say so exactly. I mean, he did mention VAT one time, so I think that's how they did it. Is they're counting the VAT, the VAT, the whatever the heck VAT stands for. I don't even remember anymore. Do you guys remember exactly what that is?
Value added tax.
Yeah, there you go. I just wanted to hear Teresa get an answer right because, that's her thing. But so the value added tax isn't really protectionist because it applies to everything. It's not just imports. It's their goods too. So it's a sales tax, but the way they calculate it is and collect it is at each stage of production. So what we're doing is we're adding tariffs that are really pretty large, and they are not half what our allies and others are doing. In most cases, they're the same or more because they include the VAT. Well, if the VAT is essentially a sales tax, what is this really what we're doing? It's what I've said all along, which is this is just another way to put a national sales tax on. And they want to put a sales tax on everybody on imports because they want to lower income taxes, which we know flow 80 to 90% to the richest 1 or 2% of the population. Now, some of us are 2%ers. The economic stimulus that I put back into the economy is strictly in travel and vacation. So, while I buy a lot of things for my business, my tax break, for the most part, I spend it or I just add it to the pile. And I'm trying to be a very good spender. I am, because who cares if you die with $100 million? And the only reason I'm trying to get to 9 figures is because I want to do super cool things in Milwaukee and for my family. I am not going to die with whatever. I'm not going to die at peak value. I guarantee that. So what they're doing right now is a sales tax, and it'll end up being good for me, and it'll be good for investors that are good investors. Bad investors just get beaten anyway. But good investors and high income people are going to do very well because a sales tax to replace income tax, once you get north of the Social Security threshold, which is like 165 grand, they stop taxing you for Social Security. Having lower income taxes is just huge. All right, you get a lot of money out of it, and I don't really know what that does to stimulate the economy. I understand the concept behind low corporate taxes. I do. I mean, there's a strong economic argument for low corporate taxes or even no corporate taxes as long as they pay really good wages and benefits. So, we can go through all the economic theory here, but the bottom line is that historically, tariffs, trade wars end up being very negative for the economy for a while. And when the administration calls this Liberation Day, I just kind of scratch my head. And I've been wearing this World Series of Poker cap for a couple days now because I want to remember who the sucker at the table is. And I think it's people who think the tariffs are good for them. If you're not a 1 or 2 percenter, they're not good for you, right? If you're a 1 or 2 percenter, they're fine. But if you're the other 98%, tariffs are just a sales tax, and you're really not going to get the benefit of income tax breaks to offset it. So this is a sales tax, and it's very regressive. I don't know how this plays in the electorate. Judging from the election in Wisconsin yesterday, where Elon Musk's candidate for state Supreme Court got crushed. He lost by 8 or 9 points in what everybody thought was going to be a toss-up race. And then the school superintendent that they backed from Koch Industries, they got crushed too. So I don't know how this is all going to go in 2 or 4 years, but between now and maybe the end of the administration, we are probably going to have at least one recession scare, if not an outright recession. I mean, right now, the GDP now is showing a huge decline, and it's a decline with relation to gold as well that's pretty steep. We might be in a recession right now. One of the things that I put on my X feed, which I'm not going to put too much time into finding it, but if I do find it, it is about Las Vegas. Oh, here you go. Remember when I went to Las Vegas back in February and I said it was really slow? After I had been telling you for 4 years that Vegas was just busy, busy, busy since COVID, and it suddenly slowed down this winter. Vegas is suddenly slow. I don't know if there's an exact correlation to the economy with how well Vegas is doing, but I mean, that's where people go with disposable money. There might not be as much money to dispose of for 98% of the people anymore. I'm not feeling good about the economy. I think virtually all the numbers support that. I'm not just having a feeling, I'm looking at the evidence. And the GDP plunging. It's hard to see a V-shaped recovery. I did some searches on Perplexity, and I asked very specific questions about foreign direct investment. I knew what to ask. It took me 4 or 5 or 7 tries, but I got the answer that I was looking for. Foreign investment into U.S. treasuries and into the U.S. stock market fell off in February. And it looks like, and we won't know for a couple more days, looks like they fell off again in March. And I would pose a question to anybody who wants to think this through critically is, what does liquidity in the markets look like, given that we know that it's like 99% correlated to asset prices, if the baby boomers aren't putting new money to work anymore, if the millennials just don't have that much yet, if international investors aren't propping things up? And international investment in the United States was at record levels the last 2 years of Joe Biden's presidency. So if it's falling, and the millennials, even though they are entering their peak earning years, still aren't quite there yet, they're not offsetting the boomers, they're not replacing what the boomers have been putting in, that really only leaves quantitative easing. And as I've said, I don't expect quantitative easing until there's a real crisis. Jerome Powell is not going to do it preemptively. He needs to see evidence that bad things are happening to justify doing quantitative easing. And it has to be called a bailout, right? He has to be seen as bailing out. Think about the politics here. He has to be seen as bailing out the system, as bailing out President Trump. He's not going to do it otherwise. They're not buddies, right? They didn't go into this with a plan together. I have told you for years, I expected massive quantitative easing, at least 15 trillion, to bail out the retirement system. And I think it's going to have to be more if we have to completely rejigger the international trade order. The problem And technology plays a role here. I mean, there's a lot of moving parts. I mean, to what extent does AI and robotics change labor to begin with? But how do we deal with a world where we have less? Let me open that in a new image so I can close this one. If we have less international trade, people want to say, "Oh, the globalists this and the globalists that." Well, I'm gonna pose something to you. We're the richest country on the planet. We're richer than Saudi Arabia, and we did it with some of the lowest tariffs in the world. When you listen to a Mark Cuban or a CEO of any company, they will tell you if something's working, don't change it, don't break it. I'm very worried that we broke something just now, and so we will see how that works out. I want to pull up the S&P 500 chart, and it's a little hard to read. I don't know why it's doing that. Yeah, well,
Should be a clean image.
This is it. This is what popped up. So when we take a look at the S&P 500, we have these different levels that we can hit. So I'm going to bring Shooter on right here, but we're at a support level right now.
Yep.
And it sounds like we're going to break through it. So, or it looks like we're going to break through it. So Shooter, what happens if we break through this? I mean, this is 450.
There really is no support down there. I mean, you got a little bit, and forgive me, I can't see the chart enough to tell you what that number is, but
450.
Gotta get the right time frame. Sorry. So the first support that we're going to have is right around 501.
And that one's mine. All right. Here, let's take a look at my chart. It's similar enough.
Oh, I just couldn't see the number to the right of the screen. It was too small in the image.
Yeah, 501 right about here.
Yeah, next level. That's when the structure breaks at 494.36.
Yeah.
And then the base of that structure really comes down to between 427 and 450. I'll be really surprised if the lower side of the second standard deviation gets broke at 379. That'll surprise me.
So you think this green box down here holds?
Yeah.
I hope you're right.
Yeah, I mean, we need, if you just look at what we're doing already, the news is out, right? And we went down to about 5.17% down, and we backed up to about 423, and now we're back to about 409. So, I mean, it's leveling out already.
Right.
So the news is over. I mean, we might get a pop in the morning to the downside when we open, but they'll bid that. Now, if our dip buyers don't come in tomorrow morning, that's a different story.
Well, my argument. My argument is that there aren't enough dip buyers.
Yeah,
if the foreigners don't buy U.S. stocks, the millennials don't have the pocketbooks, and if momentum to the downside manifests, the millennials are good enough traders that they're going to go short. And if they go short and they can scare people, which I think they'll be able to, I don't see a reason. I don't see a reason why we can't break this level. I mean, I don't think that we will, but there's not a logical reason why we can't. So we own S&P 500 puts right now.
Yep.
And the thing I would tell people is respect the momentum, but understand the time value left on your puts. I'm pretty likely to close my puts this week. I might even close them in the morning and just take my double, triple, quadruple, whatever it's going to end up being. And because they expire in 2.5 weeks. And if suddenly over the weekend on the Sunday morning talk shows, they go, "Oh, we've reached a bunch of deals. We're not putting all these tariffs on. I don't want to lose my gains."
Yeah.
That can happen. There's no way to predict what's going to happen. So I think you have to take the bird in hand and take your gains on these puts in the morning or maybe Friday. But typically Fridays, things kind of level out. Whether they're down, they get back to the middle. They're up, they get back to the middle. So Fridays aren't the greatest trading day. In fact, sometimes they're a good day to establish positions. I'm probably going to close my puts tomorrow. I don't know when. I'm going to respect the momentum, and I'm going to be looking at this market all morning. And we'll see what happens over the course of the day. Teresa, I have your QQQ chart, and this is the area that we've been targeting for a long time now. Do you think that this is potentially going to break? And we don't have the next buy zone here, but where do you remember the next buy zone being if this support doesn't hold tomorrow?
What just happened there? Okay, I have to just change one little quick thing. No, I think that Kirk, what you say about a bear market, I think a lot of this depends on, do you see this as just a pullback, or do you really see this as a bear market? Because I mean, if it is a bear market, then, where does Powell step in? That's the question, right? Because that just means it's going to keep going down. That means it's going to hit the monthly buy zone. It will bounce, but then it means it'll just go back, and it'll just continue to go down the way that the markets go up, right?
Yeah.
So at what point does Powell come in? To answer your question, that's that. Okay, I said some monthly now. 342 to 375.
So down here, one more level.
Yeah.
So the thing that I would throw out there is that I don't think there's any reason why we can't have a double bottom to the 2022 lows.
I would agree with you. Look at how that's breaking. Look how it's broken the trend line. So
Right.
that means that on a weekly, which is how we invest, it's now down. The trend line, I mean, we haven't established a downtrend yet. All we know is we've broken the uptrend.
Right. Here's what I would say, and let me pull a QQQ chart up here real quick. We don't need this one. I think people don't understand what this market has done since the financial crisis, right? This is a huge, remove them. This has been a huge rally, right? This is the quantitative easing age. The problem is that we never used the quantitative easing to pay off our debt. I think we're going to have to this time, which means crowding out, which means that maybe the quantitative easing doesn't have quite the stimulative effect that it has in the past. Quantitative easing has added money to the economy every time they've done it, but we've never had to refinance $6 trillion in 2 years or 28 trillion in 5 or 6, whatever it is. The problem I see, and just going back to my econ classes and having read various texts over the years, including Keynes' general theory, the potential for crowding out is higher now than it's ever been before. We're at a point now where we might not just be able to buy our way out of this for free by kicking the can 30 or 40 or 50 years down the road. My belief is that by next year, and I don't know if Powell will take part, but by next year, I think they issue special debt bonds, 30 to 50 years, maybe 100 years, low interest rate, probably 3%, and that the Fed is told you have to buy these. And they monetize the debt over a very, very long period of time. If they do that and the budget moves towards balance, it can be very stimulative. But with all that money in the economy for a very long period of time, does that put a permanent inflationary pressure in the market that manifests in peaks and crashes? I don't know, but theoretically, I think that is possible. And I think about these theories quite a bit. So the fair value gaps that we're above the high point right now, we're going to hit it tomorrow. But all these orange lines, and the yellow is kind of the range that you'd expect, all the orange lines are in play. I don't think there's anything theoretical or even practical that says we can't go way down here and get into the Jeremy Grantham zone or the Armageddon zombie apocalypse. The foreign money not coming into the American markets is that consequential. And I don't know that the QE will have the impact that it has in the past. I think it'll have some impact. I think it'll stop a downtrend. But I'm not so sure that we get another V-shaped recovery like we did in 2018, 2020, and 2022. I don't think the people understand the confluence of events going on. Somebody asked, can I expand on crowding out? Google it, number one. But crowding out is when the government soaks up too much of the money and it can't go back into the economy. If the banks are forced into the treasury market, that means they can't do lending, which means that the economy can't lever up. The banks have been lending for the last few years because the hedge funds have been engaging in the treasury market in what's called the basis trade, where they sell futures and then buy the bonds back in the market, or it might be the other way around. But they're just skimming, and they replace the banks largely. The problem is that the hedge funds are cracking. Like, like financial collapse sort of stuff. And if the hedge funds bail on the US Treasury market and we have to refinance $6 trillion and the international markets aren't buying our bonds, what's going to happen? That's huge upward pressure on interest rates. So the contractionary pressure of not having any excess liquidity to draw upon other than what we print necessarily creates a recession, probably followed quickly by inflation, like we saw in 2021 after the bailout. So you get a collapse like 2020, and then you get inflation like 2021. And one of the things that President Trump did in his first term is he disrupted supply chains. What he's doing now, if it goes through, and I have no idea why anybody would think it wouldn't go through, is 10 times more disruptive to the supply chains. 10 times, maybe 20 times. People want to blame the Fed for inflation. It's not fully true. They did overbail COVID. I've talked about that. I talked about it in real time 4 years ago. But the disruption to the supply chains and the ability to buy things cheap on the international market hurt us and caused that inflation for a couple of years. I think that there's a good possibility that we see the same thing, and maybe it's even amplified. So we should take the lessons from 2020 to 2023 and 4. We should learn from this, because we might just be having a bigger version. And I don't know that this, and I talked about this with Shooter and the people on his Wednesday morning trading show. To me, what we talked about this morning, Shooter, right? Is that this looked like it was a distorted Head and Shoulders, that it would be steeper, and that it ended up.
Well, it could actually be an equal Head and Shoulders too, because we haven't got the right shoulder.
It could play out over a whole year, right?
Yep.
So,
hey, I just uploaded 2 NASDAQ charts in chat in Rare. Why don't you pull up the left one? I've got a harmonic on there. And then I did the weekly and the daily. I want to just show the divergence here of where we are.
Okay.
Because I think this sort of expresses you 100% here.
Oh, killing me, Smalls.
Well,
all right. So we got that one and that one. So which one do you want? Looks like they're the same. But
one's a daily, one's the weekly. The weekly is showing much more breadth to the downside. The range is 320, 336. However, the daily is reflecting that we bounce. Now, if we don't bounce, and we have about 4 to 6 days, I would say, to get a good bounce, then I would have a lot of conviction for what you're suggesting to play out. And that right there you're looking at is viable.
Yeah. People should, folks, you should be scared. We don't know that it's going to happen. But the idea that it can't is a level of ignorance that is off the charts. And when I see the cheerleaders saying this can't happen, I'm just like, what game are you watching? So this doesn't have to just keep zipping up, right? We can get a full reversion to the mean, which is way down here. Historically, corrections have overshot. In the QE age, the quantitative easing age, hasn't so much.
That puts us at 164, by the way, NASDAQ.
Yeah, we're way down in 2020 prices. But 2020, folks, it was only 1, 2, 3, 4, 5 years away. It's not that far in the rearview mirror to think, oh, that just can't happen. It was so long ago we were down at those levels. No, this isn't 1981 stuff or 1987 stuff or 1994 stuff or 2000 stuff. 5 years. Why can't we erase 5 years of gains? I'm not saying it will happen. I'm saying that there's a possibility that it will. And so you don't want...
It's not zero for sure.
Yeah, it's significantly more than zero. You don't want to rush into new holdings. Now, this line here, right? I have said low 400s is kind of my base case for QQQ. And that's kind of where all these meet, right?
Yeah, those are both the breakouts.
Yeah, so I don't know if this is going to hold or not. We'll see.
The base point of 449.34 breaks, that means you got $40 to the downside. Play it.
And that might be tomorrow.
Yeah.
So it's very important that you are defensive. And if it would change your life to see this market back to the 2022 lows, not even 2020, just 2022, 3 years ago. If by the end of this year we were at the 2022 lows, which would really start to look like a Head and Shoulders, would that change your life? If it would, you should sell down. You should sell on the first mini rebound rally. And I think we're going to get a mini rebound rally because I think when they do the budget bill, the Reconciliation Act that's coming, and I've shown this chart, the Treasury right now is doing what's called extraordinary measures, basically to keep us from defaulting on our debt. And that means that they have money on their balance sheet. They're not pushing into the economy because, hey, we got to have the money to pay the bills. Once they lift the debt ceiling, the Treasury can just put that money into the economy because they know they can borrow more. But what if they don't know they can borrow more? What if it requires quantitative easing for this debt to get serviced? Folks, the debt crisis that I talked about that I thought we'd face in 2029 or 2030, it might be here. We don't have a lot of excess money in the economy. Credit cards are delinquent. We have 6 million people behind on their mortgage. That's more than were behind on their mortgage going into the financial crisis. Granted, there's more houses, but the percentage is about the same. The leverage isn't as high. Cash buyers are just fine. So if you're a 2%er, you're in good shape. And back in 2010, I wrote an article. Actually, I'll pull it up. I don't know if I still have it published.
Yeah, so right now, Mr. Market is positioned May 450, 455, and 460 puts on the NASDAQ.
Yeah, way back in 2010, I think I took it down and just kept the annual letters for a while. Anyway, I told people in 2010, oh, here you go. There you go. The gift of real estate. I told people at the bottom of the real estate market, because it bottomed after the stock market, that if you can partner with family, because you're the rich one, to buy real estate and help them buy real estate, you should do it. Because a real estate buying opportunity will happen if we get a recession and those 6 million mortgages. You know, Steve Mnuchin is a buddy of Donald Trump, and he made a lot of money on foreclosures. So if we have a foreclosure wave, I'm just telling you, you need to find a way to participate. And I think it means you partner with people in your family or very close friends that you can have a shotgun clause on that mortgage, right? Meaning that if they welch, you take the shotgun to them. You know, I think that you might get an opportunity to buy real estate with people, and it's a great investment. So you don't buy the crummy house that has to be fixed up in a bad neighborhood. You find the crummy house in a great spot, great location, then you have them fix it up as their sweat equity. Whatever, however you want to do your partnerships on real estate, you aim at real estate that is a good investment for the next 30 years. That means probably taxes and climate and education and everything else that you have to take into account. I have talked about real estate the last few years, and I'm just bringing it up now because 6 million people behind on their mortgages, man, that's not so good. If one of them are a relative of yours, or especially a kid, you might want to talk to them. So if you think that they're doing everything they can and they're just having bad luck and they got overextended, you might want to reach out. So real estate, I think, in a more technologically advanced, AI-driven, robotic-driven world, I think real estate is going to be the store of wealth over the rest of this century. I don't think it's Bitcoin. I don't think it's gold. I think it's land. And we're getting to the point now where the whole idea of God ain't making more of it is more and more and more true. And the weird thing is, if population really truly does flatten out in the next couple decades, this is it. This is the peak in a lot of things economically. And hopefully we come out the other side, money just isn't that important because everybody's got enough of everything. It could turn out that way. On Star Trek it did. I don't see any reason why that can't happen here in real life. The problem is that, as we've talked about over and over again, transitions are frightening. Not just because it's a change, it's because we as human beings, probably 80% of us, don't handle change very well. I thrive on it. I love it. But I don't think 4 out of 5 people love change, right? They like to sit in the same spot for dinner. They like to watch their TV show. I just had tacos while I watched Jeopardy. You know, there are certain things that people want. And if it changes, especially if it changes for the worse for a while, you don't know how those protests end up, right? You don't know what happens for a while. We're humans. We've been getting better since the Dark Ages. I don't see another Dark Ages coming. However, transitions are rough. And I think you need to prepare yourself mentally and emotionally and preemptively try to help people close to you do the same thing. Because if this transition is tough, and it's hard to not see it being tough, I mean, I just hope that everything works out great and swell and it's not tough. But I can't say that's any better than a coin flip, and I think it's worse. Prepare. And I do think that thinking about your real estate strategy, even if you're 70 or 80 years old, is a pretty good thing to think about, right? And I've talked about a number of you about this personally. All right, let's take a look at a couple of charts. You know that I like Central America and South America. And the ETF, if you want to go with a country ETF, to consider, I think, is the Brazil ETF. But again,
right?
Yeah, you got to respect a downtrend. So somewhere between the dashed line and way down here, 20 to 12 is probably where it puts in a bottom. Why do I like South America, Brazil in particular? And the ILF ETF is corresponding to this. I kind of like the diversification of ILF, but a little bit more of a pure play is Brazil, technology, resources, young population, right? I don't know what kind of tariffs they're getting hit with, but I think that if we get a chance to buy Brazil and Japan and Vietnam and India on the cheap, those are the countries that have the combination of youth, technology, rule of law, and capital resources. For Japan, it's manufacturing. For all the other countries, for Vietnam, it's everything. Brazil, it's kind of everything. India, it's big growth market, right? India might do in the next 20 years what China did the last 20 years. So there are a handful of places to invest. People ask me about Europe. I think Europe is going to be rough forever, so I just avoid it. I'm going to visit. I have a hard time investing there. Now, maybe this pushes them to change their structure to be more growthy. Again, you run into the problem of how much growth is left on the planet. It's really just getting the emerging markets to not be emerging, really to have them be developed. So half of the growth of the planet's done already. It happened since World War II. The other half, maybe it happens through the middle of the century, but it's not going to be, right? It's an S curve. So the growth is no longer accelerating. It's still growth, but it's not an accelerating growth. We're past the point of accelerating growth. And in 2015 on Market Watch, I dubbed that slow growth forever. So we have to understand that the past is in the past. Think of the Lion King, right? You got to put the past behind you. And the future is only a shadow of it. It's only kind of a ripple. It's kind of a reflection, whatever it is. It's not the same. It's close, but not the same. And the acceleration is really what drives valuation. So we see that in stocks all the time. If something is growing at 30% and then the next quarter the growth rate is 25%, stock market punishes it. But if the growth rate goes from 30% to 35%, stock market rewards it. We have more stories where the growth rate is going down a little bit than going up a little bit. That means that it's all going to be difficult. Somebody asked me about Africa. What rule of law is there in Africa? Africa should be a growth market, but how do you do it? How do you do it? I have no idea. And we know that authoritarian governments and other governments that don't have really good rule of law tend to not grow. And even OPEC is tough because what if oil is just less valuable in 10 years, right? What if technology makes oil less valuable? I'm pretty sure that's happening right now. So we have a lot of change coming, and you have to decide, how do you want to handle it? If you think that investing every 3% down is a good idea, I have one word for you, martingale, right? You're just going to spin yourself into a hole. Oh, I just kept buying on the way down. Yeah, well, now you're down 50%. Slow, small, wide price points. Respect the momentum, because a lot of these charts look like they can fall off cliffs. We can go through chart after chart after chart. I do think the clean energy is the closest to being a buy. So TAN in the lower 20s, I think you gotta just hold your nose. iClean around 10, 9 or 10. I think you gotta hold your nose and buy it. And keep in your head something that we know, right? I have this one annotated. Who is the driver of the FOMO stocks? What generation? Anyone?
The millennials.
Millennials. If the millennials don't like it, don't invest in it. It is that simple at this point. If the millennials aren't going to put it in their portfolios, don't freaking buy it. When somebody tells you about, big coal is coming back, kiss my ass, right? If somebody tells you that this consumer staple stock is undervalued by 20%, right? Just zuck off. You just can't overstate how many bad investment ideas are out there. 4 out of 5 investment ideas are crap. So you're left with 1 in 5 to figure out, and probably a third of them really end up being ideas that you should spend the time getting to know. And if you can't know something well by doing the reading, stick to ETFs. Understand the total addressable market of a company has to be big for the stock to get big, right? Newsmax is worth $30 billion right now. There's no way that they have a $30 billion potential total addressable market, much less market cap. Their revenues were under $100 million. Well, they have like a 300 PE or something, or a 3,000 PE. I don't know, some obnoxious number. So you take a look at some of these, and for Shooter, who is a trading savant, if you're in the Rare chat room and you're trading with him, I can't tell you the number of people who told us this, but there was a lot of people who doubled their money last year. I think Shooter and Teresa, both of your trading accounts are about double. Were you better than that, Shooter?
I'm up almost 400 for this year.
Last year, well, over the last year.
Last year, I ended at 362.
Right, that's pretty good. It's a trading.
I got walloped a couple times.
Yeah, it's a trading account, and it's not all his money. But the point is that the trading, for those who have the gumption and the time, the emotional stability. Sidney Moncrief, Milwaukee Bucks, I used to watch as a kid. The coach described him as having incredible intestinal fortitude, guts. The weird thing about investing, just like poker, is you actually have to be scared all the time. And then you have to find a moment to pull the trigger anyway, right? Because it's a good bet. So, Shooter, what do you want me to show people before we call it a night?
I think HYG, did you pull that one?
I actually did.
There actually were a couple of other ones I sent you too.
Yeah, I got them. Bitcoin, Spider, Treasuries. Here we go. I am having a really hard time getting these to be big.
I don't know why. They should. That's trading view.
Yeah, I think it's whatever. It's a setting somewhere that we don't understand.
Here's my thesis with HYG.
This is fine. So when we take a look at HYG, you think it might rally. This is high yield corporate debt.
I think it gets a bid with. I think so many companies are going into AI and it's not cheap. We haven't seen the price increase it yet. Right now, OpenAI, for example, is talking about going to a $20,000 PhD box, and then they want to go to a $20,000 engineering box. So what they've done is just I'm a great example of it. I've spent a lot of time learning what I've done. It's functional. It works. It definitely is performing. The question is, will I pay 20 grand a month for it? I think, and ultimately, I think what you're going to see is a major shift with larger companies that have now adapted AI. And I think they're going to go out and they're going to have to borrow to put that as infrastructures in-house, because you basically can buy the LLM and install it and run it in-house. When you're starting to talk $20,000 to hook up one PhD to it, what happens if you have 500?
Yeah.
So I think that is going to roll into something like HYG, because this is where they're going to go to borrow the money.
Right, but if okay, so let me ask. Let's work through this for high yield debt. This is high yield debt. If the demand for high yield debt goes up into a liquidity constrained market, that means interest rates go up, which means that this has to fall off a cliff before it can go up.
Yeah, it's going to be the big dog eat dog. That's what it is right now. Either you have the big machine or you're not part of the game.
Right, but this is a bond fund. This is a bond fund, which means that
the corporations sell the bond to raise capital.
Right, but if that means they're demanding money,
yeah,
that might not be out there, which means they have to offer a higher interest rate, which means that the bonds go down first.
Yes.
So it's a trough that we have to look to buy. So it looks like somewhere in the 70s for sure. This is like 72, 74. It has to come down before
it would be better if that occurred, but if my thesis is right, we're going to either you buy it on the breakout or you miss the run back up to resistance.
Yeah. That's a trade. I will say that I have never bought high yield bonds except after a crash in 30 years. So unless we get this, like we saw in 2020.
I can understand wanting that conviction.
Well, because the potential gain isn't big enough.
Yeah.
Right. So I'd rather just sell a put on the S&P 500 and probably make the same yield, right? So, if this crashes and his thesis is right, then think about the time lag, right? It gets down here to 72, 73, 74, and then it starts to rebound late in the year or next year. And then you have a big upside as theoretically the economic cycle plays out well and interest rates come down. We'll see. Again, I look at everything through the lens of liquidity, and either the foreign investors come back or we print a lot of money, or both. We're going to be constrained on liquidity until then, because the baby boomers are not putting money into the stock market anymore. I mean, there's some trading, right? There's some asset allocation shifting, but 2/3 of the boomers are retired now. The rest of them retire between now and 2030. The pensions, which basically control boomer money, the public pensions, right, for municipalities and states, are already in net outflow, means they're selling both equities and treasuries. And the corporate pensions, which are fully funded, the public ones aren't, are basically breaking even. So they have lost 75% of their inflows the last 7 years, so about 10% a year. By 2027 or 8, there's no more money going into any pensions anywhere on net in the United States. That means all the pensions are net sellers by the end of the decade. So, when I've said 2029, 30 is when I thought the crisis would come, it was clearly to me a potential confluence of many, many things that could go wrong at about the same time. Maximum Medicare and Social Security, no money going in from the pensions, huge debt that has to be refinanced, private credit that's all cracking, which might be cracking already, actually. People falling behind on mortgages that, because their debt to income ratio is 50 or 60% instead of 20 or 30. I thought all this stuff would happen in 2029 or 30, give or take. Maybe all these things play out, but instead of over a 1 or 2 year period, over a 5 or 6 year period, which means this is going to be a range-bound, choppy period, with the bottom of the range at this point being unknown, and the top of the range probably not terribly much higher than the recent highs. And maybe those were the highs for the rest of the decade. Now, I think that they will overstimulate, they'll over QE, right? That's our MO. We'll overdo it. We'll say, well, we need 15 trillion, so let's press the 19 trillion button.
They'll wait until there's a problem.
Yeah. You're right. There will be a crisis first.
Yeah.
But they'll try to fix it fast, just like they did with COVID.
Yeah.
And now that the Republicans have 7-seat advantage in the House, they should be able to get most stuff through. And I think by next year, that's maybe gone. So if you think about this from a conspiracy theorist standpoint, and remember what I say about conspiracies, most of them are wrong, but a few of them are true. And you got to find the ones that are true, because otherwise the conspirators have won. I think that it's very likely that we get all our catastrophes out of the way well ahead of the elections next year. It'll be this year and early next year. And then we get a new Fed chairman, and we get another reconciliation bill, and we get any bailouts that we need to get, because even the Democrats love bailouts. They'll be like, hey, we're closet monetary theorists. Let's print money, So we'll see how that plays out. But in the short run, make your list of what you want to own. I strongly encourage you to focus on growth and total addressable markets. I understand that people want to just set it and forget it and buy dividend stocks. It doesn't work.
It's going to get expensive this year.
Yeah, dividend growth works because there's growth, right? So you have to have the underlying growth even in a dividend stock. So when I take a look at a stock like Pfizer, it's because it's not just because it has a big fat dividend. Right, it's got it better than a bond rate dividend. It's over 5%, so that's interesting to me. But what I really look at with Pfizer is I'm getting it cheap, I think, and there is the potential, might not happen, but there is the potential that AI and all their data pumps out some blockbuster drugs in the next 5 years, and suddenly it's $100 stock from 25. Right, maybe it's in the 30s forever. Right, it gets back into the 30s and it just chops along, but that's still good. Plus, when you throw on that big dividend, they have the potential to break out in a big way. A couple of the others do as well, some of the big pharma, some of the big biotech. Everybody who likes to gamble on the small biotech, the problem is almost none of them are capitalized in a way where a blockbuster does anything but keep them in business. There's a few, like 1 or 2%, end up breaking out and becoming big deals. But in this era of AI, and capital has won, folks, right? Labor is not above capital. Capital is one. Big checkbooks win. It's just the way it is. If you take a look at the real estate market right now, what deals are getting done? The people who come in and say, I want to buy that $1 million house with a check. I don't need the bank. Here's a check. And biotech is like that. You need data, you need money, you need talent, you need to be able to buy the top AI. And the top AI compared to the run-of-the-mill AI is a big difference right now. And the quantitative learning models, the quantitative models, right? Everybody talks about large language models. That's done. They're all programmed. They happen fast. When you go on to Perplexity and you do a search, I use the deep research all the time, but they also have, hold on, I jammed it up. I'm pressing buttons. So we've been to Sandbox AQ before, right? Sandbox AQ. We have been because it popped up, right? Large quantitative models. This isn't just all the data and all the stuff that's ever been published. This is analyzing it. It's taken math and reasoning, and on Perplexity, it's called the reasoning model, and it's just figuring stuff out. Oh, here's all the data. Let's do the calculation for you 10,000 times or 1,000,000 times, and I'll give you, an answer that's 93% likely to be correct in minutes. So, yeah. So the quantitative modeling that's out there right now, which is basically what Shooter's playing with, it's going to change everything. And
I just don't see it at this point.
And people still don't understand that right now I have an edge with AI because I know which questions to ask. I don't know how long I have that edge. At some point, the AI is going to know the question to ask. Kirk, did you mean this?
He's going to be able to predict what question you're going to ask.
Well, it's going to be able to just say, look, idiot, human, go fishing, and I will do this for you. And I don't know how long that lasts. I mean, I don't know when it happens, but the quantitative analysis of data is a big deal. The thing that I don't think AI will ever do well is have intuitive judgment. And I think it has a hard time predicting the stupidity of humans.
It can't. No, I agree.
Right.
So you can have a bad actor sending crappy data and screw it all up. So you still need the supervisor.
Right. So when I play poker, and I just cashed 14 out of 15 large tournaments, I have been on a run. I don't know what I did to my brain, but I fixed it. And it might be accidental. It might be broken again by June. I hope not. But the hardest part of winning at poker isn't outplaying people. It's avoiding the idiot that calls you for no apparent reason and gets lucky, right? He shouldn't call your bet. He shouldn't call your bet again. He shouldn't call your bet on the river, and he hits his 3-outer because he chased it all the way there, and 6% of the time he's going to blow you up. That's the hardest part of poker, is not getting blown up by an idiot. Well, the AI, I don't think ever overcomes the idiots. And frankly, there's billions of them. So
there'll be a lot of them that won't get in there, though. That's just, it's too complex to understand it. They'll ask the front-facing questions, but they'll never get into where the real logic is.
Right, but my point is that there's just so much information jammed into the AIs at this point that if some of the information is bad, it's going to skew the results.
Yeah.
So, but when you tell an AI, hey, here's all the healthcare data for 1 million people and all their conditions, and it finally builds the LLM for all the genes and protein and conditions that people have had and long-term, histories of people. And then you say, okay, that disease that these people are dying of, you can see all that data. My tiny little human brain can never figure it out. I want you to find me the most likely recipe for a drug that is going to help the most people. And it's going to figure it out. And it's doing it right now. I have heard that within 2 years, we're going to have a whole new batch of drugs. And I don't know how fast the FDA is going to approve them under RFK. I don't know if it's going to be faster or slower. I do not understand what he's doing. I have 2 friends that lost their jobs yesterday from HHS and another one from the State Department a while back. And so the processes that we've had in government are completely changing. I don't know if they work out for the better or worse. I suspect worse, but who knows? Maybe it works out, it'll work out in the long run. I just don't know how it works in the short run. But by the end of the decade, we're going to have new drugs. And I think Pfizer is going to be one of them. And so that's all I'm saying, is that AI is going to be that impactful on certain things. The holy grail that everybody's trying to figure out, shooters trying to figure out, I try to figure it out, is can we just hire an algorithm to do our investing? And the reason why the answer is no.
Same reason he can't spell or write a number right.
Well, it's because everybody's got one.
No,
so if everybody's got an algorithm, right? If everybody's got an algorithm, it doesn't matter. They're just fighting with each other. So that means when I was a quant 16, 17 years ago, right, before it was cool, I was a quant before it was cool, I realized you're changing your black box really frequently. And only Renaissance has really ever stayed ahead for a long period of time. So, but if you're ahead for 5 years, you're rich and you don't have to be ahead anymore. You just kind of not lose it. So that there is something to that. I mean, once you're rich, you're rich. And if you hit your number and don't want to play no more, you take your take your ball and go home. I can take my ball and go home. I don't, because I'm greedy. And I want to do some neat things. But I think that the whole idea of having a computer do your investing for you is probably always going to require constant management and change, because everybody's always catching you, right? The market just keeps adjusting to new algorithms. So it ends up not being much different than it is. And if you just let the traders be traders and do the overshoots to the upside or downside, right? Get outside of the second standard deviation. You just buy when we're below 2 standard deviations and you sell when we're above 2 standard deviations, even though we actually were 3 standard deviations to the high side this couple months ago. So, the last time that happened was 2021 and we had a correction. We're getting a correction now. How far down does it go? Does it just go to the middle? Does it go to normal, or does it overshoot normal? What I'm trying to tell you is I don't know if we just get to the mean and then bounce off it. I think we might go through the mean and overshoot and get PE ratios of 10, right? In 2008, we got single-digit PE ratios. In 2002, we had single-digit PE ratios. I'm not saying it's going to happen. I'm just saying don't throw it out as it can't. Teresa,
that's one reason Berkshire is buying Japan, because a lot of the PEs are below 10.
They see it as safer. They're like, well, maybe we don't make a lot of money, but we probably don't lose. Teresa, you got something smart to say. Say it. What do you need to say? Because I can see it on your face. I can see the wheels going in Teresa's brain here. What's going on?
Yeah, no, it's interesting talking about the AIs, because I've thought about that, and it literally will be just AIs trading against AIs. I agree 100% with what you're saying. So there's a first mover advantage, and then that's it. Everything catches up. One thing that I've noticed, though, just charting, is I'm starting to think that our monthly charts are in charge these days, and they're the more pertinent ones to be paying attention to. I look at a chart like, I think it was Google, there's QQQs, because I drew the monthly buy zone on that. I did one that I posted in chat of the S&P, and just said, well, what would it be like if our trend was from 2009? What does that give us? And then put it, it's got to, keep going up. It's got a big, I can see it right away as soon as you hit it. There, that one. So I just said, go back to 2009. Actually, it says monthly there. It says weekly. That's actually a monthly chart. And I just drew the trend line saying, well, what if it's 2009? What if we're reverting back to a mean from 2009? Then that easily puts us down at the 4,000, easily. And then if we're going to break below that trend, then that takes us down to the 2,500, whatever level we wind up at.
Right. And it
just feels like that, right?
Yeah. This market right here, 2014, 15, 16, where it kind of chopped sideways, right? After 2.5 years, it was basically in that one box.
Yeah.
I think that this is the new base of the market. I don't think we can go back to here, but I think we can go back to here. I don't think it's likely, but it's not out of the question. I do think that this one is pretty reasonable to see that it can happen, right? 4,000-ish. 2022 lows, I just think, are tremendously in play. I don't know what's in play after that. Hopefully I figure it out if it's happening in real time, right? And again, respect the momentum, folks. Respect the momentum. If everything's breaking, don't get brave and lay underneath. Oh, look, that that sword is falling. I'm going to go lay underneath and see if I can catch it before it hits me in the chest. Don't do that. So I don't know. Folks, let me take a look at the questions here. Somebody asked about their May puts. I would be slowly scaling out of them, but I don't think that you need to sell them outright. But, if you can make it a free position tomorrow, free is good. What does a rebound rally look like? I don't think particularly big. 2 weeks ago, when we were at the end of the 10% correction, what did I say? I said if the market wasn't up 4% in 2 weeks and then held it, we're having a bear market. We're not going to be up 4% over those 2 weeks, so there's not anything to hold. We're in a bear market, folks. I guess I hadn't really outright said that. We're in a bear market. I don't know there's any way to say that we're not. It's just a matter, is it a 20% bear market or is it a 30, 40, or 50% bear market? Don't know. And I'm not going to get real aggressive until I know. I will say, and I'm going to have a lot of stuff out this weekend. I think that there are a handful of puts you can sell tomorrow. Favorite stocks. Make sure you take a look at the chart. Respect the chart. I know a lot of you aren't chartists. You don't have to draw the chart. You just have to be able to look at it like this and go, okay, I kind of understand what Kirk and Teresa and Scott are putting out there, right? I can tell that it looks like it bent upward too long. And, just respect it. And certain things, small caps and mid caps in particular, sometimes they're just so darn cheap, you don't worry about technicals. You just say, okay, are they in business in 5 years? If they are, I'm buying them, right? And that's just the way that it is. Because most small and mid caps are catalyst driven, not S&P 500 liquidity driven, right? It's all about, are they going to execute? Are investors going to discover them? How have I positioned my ETF portfolios in the current market? So I have to put that update out, but I did put it in chat. I'm 30 or 40% in cash and 30% in cash, 40% in intermediate term government bonds. I think it was 10% gold and then 20% stock market stuff, but only 10% US equities. So my 401k plan, which is really the only ETF portfolios I have at the moment because everything else is heavy cash, the ETF portfolios, even those are super heavy cash and intermediate term bond investments with only 10% in the US equity market. I mean, it's about as conservative as you get, right? Because you can't short in a 401k plan. The ETF only portfolios at my firm are 75% cash. And then I throw a couple of stocks in there because they're not really 100% ETF, but a little bit of Berkshire Hathaway, that sort of thing. So, there's not really any ETF zone just yet, unless you're buying intermediate term bonds on the idea that 5-year interest rates go down, right? It's bad. Shooter, closing thoughts.
Stay small if you're going to step into this. And my gut is wait.
Yeah.
Because once that 449 breaks, it's going to take you down 20%.
Yeah.
There's a big cliff there. Yeah. There's no reason to go in now, be candid. You're better off sitting on the sideline. If you have access to tips, government retirement, it's probably the best play on the market right now.
Yeah. On the 4-hour chart, we officially have a downtrend. Are we officially a downtrend on the daily chart? Yeah, we are now. And I think it's sharper. See, the Elliott wave is saying pretty sharp drop.
Mm-hmm. Right now, it should be measuring a 5 down. So we still have 3 coming.
Yeah, weekly chart is still up, but we just broke it.
Yeah, and it's going to be tight and fast the way that looks.
Yeah. Well, I put this bullseye with a question mark weeks and weeks ago. So, my orders are at like 410. And I don't know if I'm going to move them up or down. I just don't know yet. Because the monthly chart, I think that...
On QQQ, right?
Well, this one's SPY.
Oh, okay.
Oh, yeah, on QQQ, yes. QQQ, I have my orders down at like 410. So I guess I should do QQQ. There you go. So my orders are here, but because I thought this peak might hold. If Trump had not said what he said, I thought this might hold. I thought we'd have bull market support. I don't think so. And I don't even think Jerome Powell, because I think we have a whole month to the next meeting. Yeah. And he's not doing anything between meetings.
There's not one sector that's going to be hit more than the NASDAQ with high tariffs.
So they have it worse. Do you think? I mean, yeah. I know it's long to
the Mag 7 is just going to get killed, especially Apple sales are already down 1%. They didn't recover. I'm still surprised they didn't really flush.
Yeah. What are the home builder? Is it XLB?
Yeah.
No, that's not it. What's the home builders ETFs? There's two of them on our list. I haven't looked at them in a while.
Hold on, I'm looking.
ITB.
ITB is one of them. And what's in
Yep, and XHB.
Just found them. So I think if I can find my freaking charts, ITB. I do think clean energy is close. I think they're the closest. But ITB, I think that this is a correction I'm going to want to buy because I think the potential for a massive rally, and look how much it mirrors S&P. I guess we should probably put SPY in there and see if it actually outperforms. Go back to 2016. Yeah, it beats SPY. And what about what do you say, XLB?
ITB XHB.
HB, home builders, duh. Sometimes they actually make it make sense. All right, did it not add? All right, so ITB is the one we want. If we get a big correction in the home builders, and if they do what I think they need to do, maybe they don't do it this reconciliation bill, maybe it's next year. I think there has to be a tax credit for building new homes. It's stimulative to the economy, and it actually would hold inflation down once the houses are built. During the house building period, it doesn't bring inflation down, but once there's inventory, it brings inflation down. If this corrects down in here, I think it's a no-brainer buy because it falls into that category of the government will help it. That's my thought. Not so sure that I'm right. I meant to buy it down here. I talked about it. I never did. I regret not because it almost tripled. But I think that if we get a retest at the 2022 lows, and this in my head, and this is really what I'm thinking, is I think I'm going to get a chance to buy a lot of things at 2022 lows, and we're close enough to the bailouts that the minute they utter QE, I'm buying. I'm not even going to wait for them to print it. So there you go. Now, I don't know that the rally afterwards is as big as the last ones from QE, but if they press the extra money button, which politicians tend to do, then you get a chance to triple your money maybe in a few years.
IBP and HOV, both of those look good. Both of them have triggers and home builders.
Yeah, so they're all kind of similar. I will compare some of these. Now, I try to only use ETFs to have options because that means there's depth to the market. So I will check some of these other ones out. What was the other one? HOB?
Yep, Habnonian. It's a builder. It's the only builder that actually looks good. Nice base. We got a divergent low. We actually had volume today, up about $6.
HOB?
HOV.
OV. Yes. Ah, you with your Texas drawl.
Really have a Texas draw?
No, I was messing with you. I can't hear.
I was like, oh, no, please.
Oh, wow, that's pretty interesting, huh?
Yeah.
Yeah, you should probably be playing with that in rare, I would think. I think the overshoot is down to 60. That would, if it goes from 106 to 60, right? It becomes kind of a screaming buy, right?
Yep.
I don't know.
Run a tight stop if you're going to take a shot at it.
Yeah, I don't know anything about these guys. So, you know me, I'm a scaredy cat when it comes to not knowing. Wow, that's a pretty long downtrend. Okay, I'll follow it. Follow. All right. Let's call it a night. It's 8:30. So you have a jump on people right now. Share the information in chat. But basically, the answer is be patient. Tomorrow could be pretty bad. If you got April puts, you might want to take your profits just because you don't want it to get turned around on you by Monday, right? Because you're running out of time. You're running out of time to close your April puts. All right. I didn't lean on Shooter and Teresa as much as I intended to. Teresa is going to be working more on charting, and I'm going to pick up the chat recaps so I can kind of add the investment quick thoughts to it because I know that everybody liked that. So she'll only be doing the chats when I'm traveling, the chat recaps. Shooter, I have asked him to really focus on the rare trading room with just the quarterly chart updates rather than trying to give you 10 charts a week. We're going to just do a chart book every quarter, which we're working on now. It'll be out next week. And then from time to time, we'll put something in chat based on, hey, this is manifesting the way we thought it might, or it went in a different direction, so we have to update it. So we'll put updates in real time in the chat rooms here and there. But I want you to have a centralized place to go and say, hey, this is kind of the picture we're looking at, because it doesn't change that much in 3 months. So if we update the charts quarterly, yeah, I think we could get away with semi-annual, but we'll do quarterly because once we have the templates, it's doable. And it's a way for people to see what the technicals are saying. And again, I remind you, the technicals aren't 100% predictive, but they still tell a story. And think about it like an art museum. If you and two friends go into an art museum and you look at some Renaissance picture or whatever, just any piece of artwork, you're all seeing the same thing. But each of your interpretations are a little bit different. And Teresa's and Shooter's have proven to be really good interpretations. So while they're not perfect and I'm not perfect, I think they're excellent. And if they're telling you, hey, be careful, take that as be careful, right? You might not be ready. And you don't have to vacation. Yeah, you don't have to invest in a lot of things. You don't always have to be clicking the mouse, especially if you're a position trader like me. I am really looking for overshoots. If I can buy something 30% undervalued, it doesn't matter to me if it stays undervalued a while. It's cheap. I've limited my downside and there's more upside now. So are we going to get that right now? I don't know.
I think we got another 10%.
I think those 2022 lows are probably where it's going to challenge. I don't know if it gets quite there yet or not, but I think that's what it's going to try to challenge. And if it does, then there's a lot of neat things that we can do. And the fact that pretty much everybody watching is heavy in cash, don't wait to do everything at once. Selling cash secured puts incrementally every week.
Patient, wait for the trigger.
Well, but scale in, right? Don't try to be perfect.
Wait till you get a trigger, then scale.
Well, yeah, I mean, right. Respect the momentum. But, once it starts chopping sideways, you typically only have 4 to 8 weeks to get in. And that's a pretty standard time frame if it's done falling off cliffs. I think this year looks either like 2022 or 2018. I don't really know which one, but 2008 is not outside the realm of possibility. We're going to find out. Exciting times. All right, everybody. Thanks a lot. Thanks, Shooter. Thanks, Teresa.
Thanks for having us.
And
thanks, Kurt.
Folks, if you're not a rare member and you're a trader, you need to become a rare member. If you're not a swing trader, it don't matter. But if you're a swing trader and you really want to trade more, you need to give Shooter a chance over at Rare. All right, everybody. Take care.
Have a great night.
Good night.